Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and you've joined our webinar today on trading micros at the CME Group. I'm very pleased to have with us today David Lerman, the Senior Director for Education at the CME Group. We also have Craig Bewick, Director for Client Development and Sales, who will be participating as well and trying to answer the questions that you do submit. So with that, what I'd like to do is I'm going to pass the controls over to Dave. If you could go ahead and share your screen, we'll get underway here this afternoon. Thanks for joining us, Dave and Craig.
Thank you, Cynthia. You all can hear me loud and clear?
Yes, we do. And if you could put your slides in full screen, let's get underway. Thanks.
Okay. Thank you so much. Well, on behalf of myself and the CME Group and Craig Bewick, we want to thank Interactive Brokers. We've done a lot of webinars with Interactive over the years, and we always enjoy. One, you get an amazingly large crowd, and usually a pretty sophisticated audience. So we'll try to turn this up a few notches, and if we see the questions at a more basic level, we'll turn it down a few notches. We have that flexibility. I have with me Craig Bewick, who actually just recently, I think, was promoted. He's the Senior Director up in Client Development and Sales. He works in our retail with our retail and active traders, and of course is responsible for the account at Interactive Brokers. We both worked with Cynthia for many, many years. Craig will jump in and chime in anytime he feels necessary. He will also answer some of the questions, and of course I will too. If I see a lot of questions on one particular topic that seems to be really germane on the slide that I'm on, I'll stop for a moment, but we're going to try to take all the questions at the end of the webinar. We'll go around 45, 50 minutes, maybe a little bit longer, and then we'll take questions. And Craig and I will stick around as long as necessary to answer the most of the questions, the bulk of the questions. So anyways, welcome to Trading Smaller Size Contracts at CME Group, how smart money uses the micro and the mini size contracts. We have our own disclaimer too. Just remember, futures trading, options trading, and swaps trading, and they're not suitable for all investors. Each involves the risk of loss. You must do your homework. Interactive Brokers has lots of resources for you to work with, a lot of capable people that can help steer you along the process of learning if you're early in your learning curve. We also at the CME Group, we have a lot of educational modules and webinars, and the retail folks, Craig's group, also have a lot of resources available for people that want to advance their learning curve. So, quick thing there from Warren Buffett. We always invest in education, and he agrees the best investment you can make is an investment in yourself. The more you learn, the more you learn. That's general, by the way. There's a lot of very, very smart people that don't necessarily earn a lot, but I love the quote. Okay, let's just talk a little bit about why active traders trade smaller size products and why they've become so popular over there since, these things were launched long before we did the micro E-mini equities back in May of last year. We had some micro products and currencies and some other products too, and some other type of E-mini products. But in general, people like them. One, execution costs and liquidity. Most of our products are very liquid. They're available, around the clock pretty much. The execution costs are very small. Pound for pound futures are a very inexpensive way to get into the market. You put up, we'll talk about capital efficiencies in a second, but you put up a small amount, you control a larger amount, and the costs are very, very minimal. So it's a way to, really participate in the market in a very efficient way. So you get an execution costs and liquidity are amongst the best. Some of our products are the most liquid in the financial world. Our Euro-dollar futures, our E-mini S&P, crude oil, the Treasury complex are all incredibly liquid. And our recently launched micro products are also very, very liquid. We have a great market maker program in most of them, and they just do well. Plus, we have a lot of participation, and we have you folks to thank for that. There's a lot of active trader and retail participation, and that helps build liquidity and build the order book. Two, capital efficiencies. Very simple. You put down a small amount of money, and we're going to address margins a lot throughout this presentation because the last 4 weeks have seen some margin increases, some significant ones, as a matter of fact. And I'll have some examples with the new margins and some examples with some of the older margins. You get a little bit of an idea of how much they've changed. But you put down a very small amount of money, 2, 3, 4, maybe 5%, and you control a lot more. So you do have reasonable leverage there. The only contract that we have where there is a very large margin account is our Bitcoin futures contract. And that was because it was extremely risky. It moved around a lot. It was doubling, quadrupling in a matter of months and then losing half its value in a couple of days. So when there's ever a perceived amount of risk or an actual amount of risk, the clearinghouse raises margins. And as we've seen, there's been a tremendous amount of volatility in the last couple of weeks. And so therefore they raise margins in accordance with that because the risk is greater. As we mentioned, third point, around the clock trading. It's very good. So if you want to initiate or offset a position because something happens over in Asia or in Europe, you can do so. Fourth reason, strategic reasons. There's things that you could do in futures that you can't do in the stock market or the ETF market. There's spread trades, there's carry trades, there's all sorts of combination trades, intermarket spreads, intramarket spreads that you just cannot do in the stock market. Or if you can, it's just very, very expensive and very capital intensive. The fifth reason is the direct participation in the markets. And we're going to see a glaring example of this later on. I'm going to compare doing the mini crude, not a true micro product, but its notional value is very, very small. It's half that of crude oil, regular crude oil contract at 500 barrels. But people ask me, what's the best way to play a bear market or a bull market in the energy markets in crude oil? And it's like, well, you can do it with ExxonMobil. You can do it with the XLE ETF. Or you can do it with WTI, either a large size crude or a micro or mini crude. And that'll get you more direct participation, it'll correlate much better. The ExxonMobil stock price or the ETF's price doesn't always correlate one-to-one or whatever with underlying crude oil prices. So it's sometimes there's a tracking error issue. So that's one very good reason, another very good reason why active traders are flocking to some of our micro products and mini products. Sixth, full offset with E-mini futures. So if you do 10 micro E-mini S&Ps and you do one E-mini S&P, the opposite side of the trade, that will be a full offset. Now, that's not fungible. It's an offset. You can't take 10 micros and turn it into one mini. But at expiration or at final settlement, the clearinghouse or your clearing firm will offset that and your risk will basically be zero. The clearinghouse, seventh reason why futures are a really good idea. Clearinghouse margining system forces active risk management. It's been said that if you don't have good risk management practices, the futures market can be a painful place for you. But other people say if you don't have good risk management processes in place, the futures market's perfect for you because they will force good risk management, active risk management. And we've seen that in the last 4 weeks. People don't understand marginings and variation margins and settlement margins and things like that. You can actually have your position sold out from under you. That works similar to the stock market, but being leveraged vehicles, putting up a small amount to control a large amount, you will have to just be better. Your risk manager will have to be a little bit more precise. Actually, in some cases, a lot more precise. The eighth reason is you can precisely, with micros and some of the minis, you can more precisely scale in or out of positions, and it'll allow you to fine-tune your exposure. We'll have a good example on that later. We'll have a couple of trading examples. We'll have one hedging example, and we'll talk about all these things. 9 is for people in the United States, tax considerations. We'll go into really good detail about that, but that's one of the things that gets people to cross over from trading stocks or ETFs or mutual funds is the great tax efficiencies of trading micros and minis. 10th, the technical indicators that people use for stocks or ETFs, all of those, oscillators, Bollinger Bands and things like that, all applicable to trading futures, such as micro futures. And 11th reason for those newcomers, the CME Group, we've been in business for nearly 2 centuries. We've made our share of mistakes, but we have had our share of successes. But there's one thing we've done very, very well for 2 centuries. It's risk management, and we've done all well. So we wouldn't have the success in the business that we have if we didn't have competencies in clearing and trade management and, of course, the products. So diversifying with small size contracts. One of the nice things that you can do, one of the needs of an active trader and a hedger is, the ability to diversify. There's a group of traders out there called CTAs. They're like hedge funds, but instead of investing in stocks or bonds, they invest in a diversified portfolio of futures contracts. Well, now the active trader, or even a smaller active trader, can have more diversity because the micros, being as small as they are and having a small upfront margin requirement, you can put together a portfolio of a couple of futures contracts, micro E-minis, the micro currencies, and the micro metals. And, we have the micro E-minis. They, sorry about that. That's coming up in front of everybody. Micro E-mini futures, the S&P, we have the NASDAQ, the Russell 2000, and the Dow. The micro currencies, we have the euro, the standard, the big A currencies for the most part, British pound, euro, Japanese yen, Swiss franc, Aussie dollar, and Canadian dollar. And we have metals, 2 micro metals. We have a micro gold, a micro silver, and a micro palladium. Gold trades pretty good. Silver trades good. Palladium hasn't traded very actively lately, but we'll look at palladium, even the large contracts. Rather, it's not as liquid as the other metals, and there's lots of reasons for that we're not going to get into now. But all right, so let's go over how things have gone since the micro E-mini launch last May, and how the other micro contracts are doing, and then we'll look at some other things, and we'll start to drill down here and get into more detail. But you can see there's the micro E-mini equities, the futures average daily volume since the May launch. And you can see what their average daily volume was. And you can see February we gained, and in March we did very, very well with a lot of the volatility and people coming into the market and hedging and speculating, and all the active retail traders. You can see the volume just spiked there. We've done a ton of volume. There's no, we all know this, and those that are new to your learning curve. When you have a lot of volatility in the world, and the pandemic has created a lot of volatility, you get a lot more activity. Craig, did you want to say something?
Hey, Dave. Yeah, I'm getting a few questions here on whether we're going to launch options on the micros. And at this point, all we can say is that we've had a lot of demand for that, particularly the new micro equity indexes that we launched, and specifically the mini S&P and mini NASDAQ. And we are giving it serious consideration. And it's, like I said, it's something that we've had a lot of demand for since we launched the micros. And that's about all I can say right now, but we are looking at it very seriously.
Yeah, very good point. It follows that if you're going to get a really successful product, people are going to want options on it. So yeah, not at this point, but perhaps down the road, after we get past this pandemic. I don't think we're going to be launching too many products in the midst of this thing, obviously, but Craig's got a point there that we're definitely looking into it. Here's cumulative volume for the E-mini, or the micro E-minis. You can see that should naturally go up, but you can see how the curve in the last 2 months has steepened a little bit. So again, just great success since we launched those things. The 20 or 24 market makers that we have done a great job. We thank all the active traders and retail traders out there that have traded this thing, and even some institutions have jumped on board, some CTAs and hedge funds, and they've helped create a tremendous amount of liquidity. The next chart shows the mini WTI. Now it's not a micro. The micro WTI crude it's not labeled a micro. It was launched long ago. It's a mini. But with the decline in crude oil futures, now crude oil, the large contract, the standard contract's 1,000 barrels. With crude oil around $29 a barrel, it's a $29,000 contract. It used to be a $150,000 contract back in 2015 when crude was $150 a barrel. Well, the mini is 500 barrels, so it's about a $14,000 notional value of the contract. So for $15,000, and you only have to put up a small amount of that, a couple $1,000, you will control 500 barrels of crude oil. You can be your own refiner if you want. But you can see that the chart shows steady uptick in oil volume, crude oil volume in the mini back in the latter part of 2018, 2019, and of course you can see the spike in 2020 when crude oil just went nuts on the downside. Just a confluence of factors. We had this pandemic, which slowed down. No one's driving, no one's flying. And now, a couple of days after the pandemic really took hold, Russia and Saudi Arabia are in a race to zero, so to speak. And there's just a big price war. And production is running full tilt at a time when the world is using 30 million less barrels a day. They're still producing at the same rate as before the pandemic hit. So that's why crude oil dropped from $45 a barrel down to it went below 20 for a day. And that's pretty interesting in the oil patch. Yeah.
I'm going to jump in again real quick because I'm getting this question as well. And unfortunately, my answer is going to be the same as the one we just gave. A lot of questions on a micro WTI product. And same thing. Since we launched the micro equities, the two biggest sort of requests, I guess, that we've gotten are options on those micros and micro WTI contracts. So same answer. We are certainly hearing everybody loud and clear, and we're looking at it. But we don't have them just yet. Like Dave said, it's going to be tough to launch anything until things get back to some sort of normal. But we hear you guys loud and clear on the additional products. So appreciate the feedback there.
Yeah, and not only that, when you think about it, the notional value of the mini WTI is about 15,000. That's about the same as the micro E-mini S&P. So because of the tremendous bear market in crude oil, the mini was basically turned into a micro. So, but Craig's right. We're always listening to clients. We're always evolving, and we're trying to launch products that people want and want to trade. So, but good point. Thank you, Craig. Okay, also on the metals, same thing. Very good trend upward in the last couple of months with the micro gold and the micro silver. The average daily volumes have gone up dramatically, especially in the last 6 months, and of course, especially in the last 2 months, because when you have a worldwide pandemic, people go in. The two places they go into are flights of safety, and those two flights of safety are primarily treasuries and precious metals like gold. Not as much as silver, because silver is also an industrial metal. And industrial production is basically shut down. I mean, Boeing has mostly shut down its production. Ford and GM and Chrysler have all closed their plants and are, creating other things for the economy that are necessary now. So very, very interesting to see the precious metals go. We'll talk about spread trade, an interesting relationship between gold and silver too later on in this webinar. And of course, micro FX futures. They tailed off a little bit at the 2019 towards the end, last 6 months. If you looked at the implied volatility, the amount of movement in the currencies, they were near record lows or decade lows. They were incredibly low. And they finally took off a little bit with the pandemic, and they started to move a lot. So you can see there the open interest has gone up nicely, and the average daily volume was popped in the last month or two. Okay, and if you're a statistician freak there and you like stats, here's for the entire year, 2019, it's the average daily volume of all the micro products, and we included the mini WTI, and you can see there, pretty good. Average daily volume in the micro E-mini, 240,000, micro E-mini NASDAQ, 176,000. I'm not going to go down. You can see the volumes drop off. I mean, the euro does around 10,000 a day. The Aussie dollar, the micro Aussie, does about 4,700. And then volume drops off appreciably, where the Swiss franc only does a couple hundred. The Indian rupee does about a couple hundred also. Micro gold has had its day for sure, and it's doing around 22,000. It was almost double that in March of this year. And silver about 1,400 a day. Palladium's not trading. The micro palladium just not trading very well. And the crude is it's rocking higher in terms of all the people trading it, speculating on the direction of crude oil. And today is that all-important OPEC meeting that was delayed from Monday till today. So we should have some news out if it hasn't come out already. I haven't looked because obviously we're doing a seminar, but take a look at crude oil, the mini crude, the E-mini WTI. Okay, I could talk for hours on volumes and open interest and show you charts. That's great. It's an indicator of liquidity, but the best liquidity is the depth of order book, or, the top of the order book, the bid and the offer and how much is bid there. And that's what this is. This is from CME Direct. This is a front-end trading system at the CME Group. And I have at the top there MES. That's the micro E-mini S&P. And it's the March contract. It's expired. Actually, June is the front month now, but we will make the point. And you can see there, you have a quantity, and then the bid, then the offer, and then the quantity. So the bid is 33.75.25. You can see this was done in February. This is almost at the top, actually, so you can get an idea of how far down we came. So the bid is 33.75.25. The offer is 33.75.50. So the market is a quarter to a half. The quantity on the bid side is 70. The quantity on the offer is 13. So it's 70 by 13, a quarter to a half. Very good liquidity. You can do 10 lots, 5 lots, 20 lots, more than that in most cases. This is just a snapshot. A couple minutes later, it could have been more liquid. It could have been less liquid. There's also the depth of order books, a number of bids below the best bid, the top bid, and the number of offers above the top of the offer book. And we can't show that here, but it's on CME Direct. You can call that up. And there's other ways to get it on other quote vendor system. But you can go on down there.
Dave,
and I have another. Yeah.
I see on this particular slide on the screenshot, we've got some commodity codes on there, some tickers. I'm getting a few comments on what are the tickers for all these products. So to the extent that you know them off the top of your head, when you cover a particular product going forward, you might just want to mention what the ticker is on that.
Sure. No problem.
Or the commodity code. Okay.
Yeah. So yeah, you see we were just looking at the micro Emini, the bid, the offer, and then the quantity. We were looking at the top of the order book is what that's known of, the best bid, the best offer, and how much is bid there and how much is offered for the MES. MES is the commodity, the ticker symbol for the micro Emini S&P. About halfway down this same chart, you can see QM. That is the WTI, the Emini WTI, and that's the March contract. And you can see it's 51.32.5. It moves in half of a cent increment. So it's 32.5. It moves 2.5 cent increments. What am I saying? So the bid is 51.32.5. The offer is 51.350. So 325 to 350. It moves in 2.5 cent increments. And it's 13 by 20. So again, there's good liquidity there. Right below it, you see the M6E. That's the ticker symbol for the micro euro US dollar future, M6E. And all these were the March expiration, which are off the board now. And now we're into the June quarterly expiration for the most part. But you can see it's 10891, 10892. So it's 9192, 45 contracts bid, 17 offered. So yes, whatever you're going to trade, you will memorize the ticker symbol. You're going to need it to enter orders into the interactive system. You're going to need a ticker symbol, and the ticker symbols are a little bit different for certain brokers and certain clearing agents, but in general, they remain pretty much standardized. All right. So you can see there's good liquidity. Yeah.
Dave, if I could jump in here, for those that are looking
Sure.
for this list of ticker symbols, you'll find the slides for today are in the handout panel. There's a PDF there that you can simply download, and you can access these directly from the webinar. So did want to mention that. But back to you now, Dave.
Thank you. Important point. Yeah, we don't worry. We'll have tons of resources for you. We'll make the Interactive is going to make this available as a recording too. They'll have a link. The slides will be available, and there's all sorts of information on ticker symbols. We'll get you all that stuff going forward. All right, so advantages now. Let's look at trading futures versus ETFs. ETFs very popular. I would never knock ETFs. They're incredibly popular. They're very, very liquid. A long time ago, I wrote a book on both products showing the advantages and disadvantages of both contracts. So just resurrecting that now so people know, but not knocking any product here or whatever. But there are certain advantages that futures hold over the ETF market. One is annual management fees. You won't pay that in futures. You do with the ETFs, and they're deducted daily. So if you see a 10 basis point annual management fee, you think, well, if I don't hold it for a year, I don't have to pay it. It doesn't work that way. It's deducted every day. A very, very tiny fraction of that point, 10 basis points every day comes off. Capital efficiencies, this is even with the margins increasing like they have in the last month, futures easily have the advantage there. You put a very low upfront margin. It's usually 5% or less, although that's probably crept up to 5 to 7 to even almost 10% in some products. Regulation T margins with ETFs and stocks, you got to put up 50% of the purchase price. Tax advantages, you get 60-40 treatment per the IRS. You don't get those tax advantages with the ETFs. ETFs are generally, they are tax efficient because they're basically passive indexed vehicles, but not for traders. Not for traders taking a short-term capital gain. Totally different treatment for futures. Around-the-clock trading you get with futures, and you've had that for years actually. It's like the interbank foreign exchange market that's been basically 24/7 for, well, not 24/7, but around the clock for basically 60 years or so. ETF, you get some aftermarket trading, you get pre-market trading, post-market trading. There's a couple of firms out there that will allow you 24-hour access around the clock, but the liquidity, it hasn't caught up yet to the futures in general. Pattern day trader rules, there are none for futures. There are some for ETFs. So you'll have depending on how many trades you do per month, you'll have a different capital requirement in your account. So pattern day trading rules don't apply to futures. Tracking error, futures usually track very closely to the underlying cash market. There are some ETFs, there's a ton of tracking error in the underlying that exists that you should be aware of. Okay. One further thing to simplify, I can talk for hours about ETFs versus futures. They're both wonderful things, but if you look at the dollar flows into the primary futures contract and compare it to the corresponding primary ETF that tracks the underlying cash that the futures does, you'll see big difference. Emini S&P, $228 billion versus $20.4 billion for the ETF. The Emini S&P 500 versus all 7,000 ETF global, $228 billion versus about $95 billion. The future multiple is 2.4 times. So the Emini alone does 2.4 times all the ETFs around the globe. It gets even worse, the comparison, if you look at some of the interest rate futures and other futures contracts. The 10-year note does $178 billion versus not even $1 billion for the IEF ETF, which tracks the 7 to 10-year Treasury note. It's an iShare product. 349 times the notional amount business. So pretty incredible. Same thing, NASDAQ, crude oil, just multiples of trading over the ETF. So something you should consider. All right, let's look at some contract specs a little bit. We're not going to look at all of them. You memorize these on your own, and most people won't trade everything. Most people don't trade 20 products or 10 products. They limit it to a couple, or they maybe even specialize into one or two. But you can see there we have the ticker symbols. We'll look at the micro E-mini S&P. The ticker symbol is MES. So it's like the old ES, which is the mini S&P, but this is a micro, so it's got an M in front of it. Very easy to memorize it that way. Contract unit, it's 1/10 the value of the mini. Mini was 50, so this is five times the S&P. The initial margin requirement, $1,200. All right, now I have two numbers here. The margin requirement in parentheses was from February 10th. The margin requirements now, as of a couple days ago, were $1,200. So this is the upfront margin you'd have to put in your account, to trade one micro E-mini S&P. You can see it's nearly doubled, and that's because the volatility is screams higher. Volatility before the pandemic hit was around 15-16% in the S&P 500. It made it up to almost 80%, which was the high of the financial crisis back in 2008, 2009. The contract notional value is about $12,500. It was about $16,000 before the pandemic hit. Minimum price fluctuation, it's the same as the mini S&P. It's a quarter of a point, 0.25 index points, but it's worth 1/10 less because it's a 1/10 multiplier, so $1.25. Contract months is the first 5 months in the March quarterly cycle, and you can see the Globex hours. Basically starts at 5 o'clock p.m. on Sunday and goes till 4 o'clock on Sunday. So that's how it works. Again, contract.
Hey, Dave. On that, you mentioned a couple minutes ago too, on the near 24-hour access that futures and options on futures give you. I had a question on liquidity during overnight hours, and I think just generally speaking, our answer would be that in most major futures products, those markets remain pretty similar to what you'll see during the day. But I think it's fair for us to caution that in certain options markets overnight, you probably do need to be a little bit more careful of where you're putting your orders in, as there are probably some options markets that widen out a little bit from what you might see during the U.S. Daytime hours.
Good point. Yeah. It's one thing to have a market overnight. It's another thing, is it liquid? And we know in the mini, and now we know in the micro, because we have several market makers in the non-U.S. time zone, we have really, really good liquidity. You shouldn't have to worry about it. Even the mini, before the micros came along, people were doing large size trades overnight. Same can't be said for the ETF market. So there's good liquidity. Check it out. check it out. I mean, there might be times where liquidity is not so good, but that should be rare. And the bid offer spread should be very effective, very easy for you to work with. All right. Thank you, Craig. Good point.
One more thing here, Dave. I've got a question on futures versus ETFs and maintaining the futures position through a roll. And I've got a question on auto rolling. Unfortunately, we don't. CME doesn't have an auto roll function. Cynthia could jump in on what IB's capabilities are, but the fact is that if you are in a future and you want to maintain exposure through an expiration, you do need to do a spread trade in some way or another, either selling or buying the one that you're long or short, and then buying or selling the deferred month that you want to in the contract that you want to maintain exposure in.
Yep. Excellent point. Yeah, there's no real auto roll function. If you have a big institutional broker, you're a large pension fund or hedge fund or something like that, they may roll for you if you give them prior instructions. By the way, let's be fair here. When you do roll, there's an added cost. So you're going to pay your roll commission, and that adds a cost. The typical trader doesn't roll, though, but the ones that do, yes, that's a cost that you have to be aware of. Good point. And the micro metals, we'll just, again, focus on one of these, MGC. GC is the regular gold contract. MGC is the micro gold. It's a 10 troy ounce contract. That regular gold is 100 ounce, so it's 1/10 the value. Margin requirement is $835. It was lower, about $200 or $300 lower a few months ago. The contract notional amount is about $1,640. It's just 10 times the value of a price of gold. Actually, that's a little typo error. That should be 16,400. My apologies. It looked a little small. The contract notional value is 10 ounces of gold. Gold trading around $1,700 an ounce. So that should be 16,400. My apologies. The minimum price fluctuation is just like the regular gold, a dime. So it goes up a dime, goes down a dime, and that's it. Contract months, again, you can read all that. We're not going to go over every little detail in here. We want to get into strategies and some other things that people can do with these things. And the trading hours are the same thing. Our Globex opens up at 5 o'clock p.m. on Sunday, and it goes till Friday at 4 o'clock p.m. And you can see the mini crude there, the QM, and also the micro silver, the 1,000-ounce contract.
Just to clarify real quickly, Dave, you're speaking in Central Standard Time hours. Central Time zone in the U.S., not Eastern.
Thank you. Yeah. Craig and I are speaking separately. We're usually in the office in a broadcast room. He's doing it from his house. I'm doing it from my house. We're both in Chicago. Cynthia's on the East Coast in Connecticut, where IB's headquarters is. And I should clarify I should put Central Time in there for Chicagoans. Then you can make adjustments. But all right, so then we have the micro FX futures, and again, very simple. These are as of April 3rd. I updated them too. They only went up a little bit because even though the currency volatility went up, it didn't go up anywhere near as much as the fixed income markets, the energy markets, and the stock markets. So you can see M6E. 6E is the ticker symbol for the regular euro. You just put an M in front of it for the micro euro contract. The contract unit's basically a euro, and the initial margin is $215, and 12,500 euros is the contract notional value. Minimum price fluctuation is 1 pip or tick, 0.0001, and it's $1.25. Again, same hours, Central Time, 5 p.m. Sunday to 4 p.m. on Friday. We have quarterly contracts, March, June, September, these. So they follow the stock indexes and the treasuries where you have a March quarterly cycle.
Quick comment on the margin changes, Dave. I got a question on how often the CME will change that. And you can correct me if I'm wrong, but I believe that as frequently as every day when things get real volatile, if, in times like what we just saw.
Yeah. What we saw was unprecedented volatility in the stock market. We took 34% off the S&P 500 in 26 days, or basically 3 trading weeks. I've seen the clearinghouse change margins twice within a day. It can happen. It rarely happens. They usually just change it once, and if things get really volatile, they'll change it a couple days later or a week later. I was around for the crash of 87, though. They changed it twice in a day. I think there's 2 variation margin changes because we went down 23% in one day. So It's to protect clients, it's to protect the clearing firms, and it's to protect the clearing house. It's a good thing. People may not like it. The capital costs go up, but when risk goes up, you have to put up more money. That's just a function of the market, and that's the way it's worked for hundreds of years. That's a good point, Fred.
Dave, if I could jump in here, for the Trader Workstation users, we actually do show current margin requirements in the financial description. Now, for those of you using TWS, if you right-click on the ticker symbol in any of your watch lists or your portfolio and choose financial information and follow that across to the description, a separate window will open up that shows you the hours of operation as well as your margin requirements. So if you do want to see those requirements are kept up to date as they do change. But you can review them prior to trading by simply locating that information directly within TWS. Okay, back to you, Dave. Thanks.
Thank you. All right, let's move on now. Again, I want to talk about the potential tax advantages one more time. There's a little slider, and I think there's another one. We'll skip that. But let's just assume you did a really short-term trade, couple days, couple weeks. One trader did the mini NASDAQ 100, or even the micro if you wanted, okay? And then someone did the ETF, the QQQ, or did Facebook or Amazon. We're going to assume the person's in the 32% tax bracket, which is getting near the higher one, and we'll say that they made $10,000 on the trade. Trader A, who does the futures, is taxed according to the 60-40 rule, which means 60% of the gain is taxed at long-term capital gains rate, which is 15%. 40% is taxed at ordinary income of 32%. So the blended rate's around 21.8%. A trader A owes $2,180 to the IRS and keeps $7,820. Now you look at the ETF, same trader, short-term trade, makes $10,000, 32% tax bracket. He's going to pay his entire gain of $10,000 is going to be at ordinary income of 32%. So trader B owes $3,200 and gets to keep $6,800. Now you might think, all right, that's interesting. Well, if you're a good trader, so I ask you out there, all 400 or 500 of you, are you a good trader? Because if you're a good trader and you're constantly making good profits, this is going to add up. This ability to, pay less in taxes, legally, of course, this is totally legal. It's a good thing. It'll put more money in your pocket. Again, nothing wrong with, making money in ETFs or in tech stocks and things like that. But the futures will give you an advantage in terms of how your gain is going to be taxed. All right. The technical jargon is Section 1256 of the Internal Revenue Code, which you do not have to know. As long as your accountant knows it, or you can, when you do your taxes, you know it. You'll save a lot of money if you're a successful trader. That's the name of the game. You want to, cut costs everywhere you possibly can, and that's one way of doing it. All right. So how does smart money use various micro contracts? We'll start basic, and then we'll ramp up to some other things. And we're more than past the halfway point here, and I'm going to start ramping up on the speed here. All right, so scaling in, scaling out. This is actually a technique that professionals do. Floor traders do, off-floor traders, swing traders, long-term traders. I'm even guilty of doing this occasionally. So let's just say you take an individual trader, and he uses the micro futures to scale in or out. A lot of traders, 1 or 2 lot Emini traders, they can now trade 10 or 15 or 20 micro contracts and scale in or out. One of the problems with trading, when you have either less capital or you got to do a 1 lot, which we all start at 1 lot. I started at 1 lot. Craig started at 1 lot. You start with 1 lot. You buy something, or you sell it short, then you offset it and you make a profit. That's it. You're out. You buy one, you sell one, you made your profit, you're out. If the market were to continue going in your direction, you have no position now because you bought a 1 lot, you sold a 1 lot. The micros help alleviate this issue. So we have an example here, a trader, an E-mini trader, which is really a micro trader now. We'll take a mini trader though and make a comparison. He sells 1 contract at $29.29. He covers at $29.26. You can see the diagram, the chart, the candlestick chart with the 2 arrows. Well, instead of doing a mini, what if he did 10 micros? Well, he could have covered 5 lots at $29.26. Then he could have covered a couple more, a few points lower, or a point lower, $29.25. And then he could have waited for the remaining 2 or 3 contracts at $29.24 as the market dropped. So the trader profited by $150 by trading Emini, the one lot, but he could have profited by $190 by scaling out with micros. So this is one of the great things that micros do. They let you trade more contracts, and you can scale in and scale out. You can get in a few at a time. You can get out a few at a time. And it'll just make you a more efficient trader. You'll be more in tune with the market. Basically have your arms wrapped around the market a little bit more. And you'll be keeping attention to the technical nature of the market and the nature of the market, because you're going to be in longer and out longer because you have more contracts and you're scaling in and out. And this is a good thing. Whereas if you do a one-lot trader, you'd be in and then you'd be out, and that's it. And when you're out, you tend to, you don't have your finger on the pulse of the market as much as when you're in the market. Any trader can attest to this. So we're going to talk now a little bit about spreading. We're going to go over a couple of things spreading, then we're going to talk about, hopefully we'll have time to get to the doing energy ETFs versus energy futures, all right? So I'm going to skip this slide for a second here and maybe go back to it. And we'll talk about spreading with micros and the margin efficiencies of spreading with micros and spreading in stock index futures in general. I want to call your attention to the end of 2017, December of 2017. And there's a lot of data here. It shows we have one column, the date. The other column shows the Russell 2000 performance. That's small cap stocks. Sorry, that just says Russell performance. I meant Russell 2000. And the S&P 500 performance. And you have the difference, Russell minus the S&P 500, and whether the Russell outperforms. To give you some background real quickly, generally small stocks outperform large cap stocks over the very long run. 10, 20, 30, 50 years, small cap stocks do well. They're smaller companies. They grow faster. They take more risks. And they're less liquid, too. So when people pile into them, they go up faster. And when they pile out of them, they go down faster, as people have seen in the last couple of weeks. By the end of 2017, you can see the Russell was up 12.64%, but the S&P 500 was up 18%. Okay, there's a difference there of 623 basis points, or 6.23%. Small caps underperformed at that point. All right, and that happens occasionally, and they're not always going to outperform. Now you go to the next year, the middle of next year, July 20th of 2018. You can see the Russell was up 10.5%. The S&P 500 was up only 4.8%. So they were both up, but one outperformed the other by 5.7 percentage points. Why? What the heck happened? And big deal. Why am I talking about this? Well, very simple. The middle of 2018, summer of 2018 is when the trade wars really started to heat up. As a result, where is a trade war going to affect? Where is it going to have the greatest impact? Multinational corporations, the kind that make up the S&P 500, like a Caterpillar, a GM, or a Boeing, they're going to be affected by a trade war a lot more than a small cap company that doesn't really have much of a global exposure and doesn't do anything on the global scene. So they outperformed. And then you think, well, what can you do with this? Well, you could have traded this. You could trade this. You could trade the outperformance of one index versus the other, because there's a futures contract, there's a micro contract, and there's an E-mini contract on both of these indexes. So you could have traded this spread. It's more of a long-term trade, but you can do them on a shorter term. But it's not much of an intraday trade, but sometimes it can be. Lately, it was a great intraday trade. You could have traded this every day for the last few years because, well, we'll get to it. But anyway, so let's get to the end of 2018, 12/31/2018. Small cap stocks were down 12.17. The S&P 500 was down only 6%. Well, you remember there was a nasty bear market at the end of 2018. So in bear markets, even though the trade wars were still going on, in nasty bear markets, smaller, riskier companies like that make up the Russell 2000, they go down more. They get hit. They're less liquid too, so when people get out, they go down farther, faster. The S&P 500 held up relatively well, as you would expect. In a bear market, large cap companies will tend to do better. Not always, but tend to do better than small cap stocks. So Russell underperformed by 593 basis points. Then you look at 12/31/19, look what happened. The market rallied. Boy, what a difference 3 months make. The market rallied 31.29% in the S&P, clearly outperforming the Russell 2000 by about 587 basis points. Now, if we were to look at that now, again, there's trades. A trader now, you're going to start to train your mind to look for trades and things like that. These changes can be taken advantage using spread trades. So if you thought that small stocks were going to continue underperforming, you would get short small caps and you get long large caps. What's happened since the global pandemic? What do you think? Well, what's holding up is quality. There's always a flight to quality. Even though all indexes got battered really badly, the Russell was down a lot more than the S&P 500. I haven't looked at it in a day or two, but it was down 11 percentage points relative to the S&P 500 the other day. I saw the numbers. Actually, I had them written down a little bit, but can't find them. But it was 11 percentage point difference. Actually, it was more than that. A couple of days ago, the S&P 500 was down 22.97%. The Russell was down 36.95%. That's 17 full percentage points of underperformance. I've never seen the Russell underperform so much. So again, we're not allowed to make trade recommendations, but at some point you would think small cap stocks would catch up. You know, when this pandemic ends, everybody gets back to work. It could be a very interesting trade to look at. Just an idea there for you. All right, so here's the details of it. When you want to spread this trade, you'll do 2 micro Russells for every 1 micro Emini. And the reason why is the micro Russell has a much smaller notional value. Just the nature of the contract, the design of the contract. So you'll do 2, let's just say you thought the micro Russell was going to outperform. The Russell, small caps were going to outperform. You would buy 2 of those, and you get short 1 micro Emini S&P 500. And you can see there, the Russell margin, $320 times 2. By the way, this is the old margin. This margin's gone up dramatically. But you'll get a margin offset, which is going to make this still a very, very cheap trade. I'm not leaving this in like this to confuse people. I wanted to show you how margins change. But the margin now in the micro E-mini S&P is more than $660. It's about $1,200. But for the purposes of education, we're going to look at just the older margin. So 2 times 320, $640 for the Russell 2000 leg. 660 times 1 is 660 for the micro E-mini S&P leg. Total position gross margin, 1,300. You get, because you do both of these contracts, long and short, you do them at the CME Group, you get a margin offset. You get an 80% discount. So the total margin is $260. Even with the new margin probably being twice as much, you still do this trade for roughly less than $600. But the old margin would have been $260, the cost of a nice dinner in downtown Chicago when we reopened the restaurants. But anyways, that's a spread, a very simple spread using the micros, using the micro E-mini Russell 2000 and the micro E-mini S&P 500. There are lots of other spreads you can do too. Yeah.
Sorry, I've got just one comment on the margins. It's a kind of a mechanics question for futures. Somebody asked me what happens to your margin once you're already in a product or in a position. And basically the real quick answer to that is that the CME every day does what we call a mark to market. So we will mark your position, whether it made money or whether it lost money on that day, and your account will be either credited or debited, depending on whether you made or lost money on that. So that's how the margins work after you've established a position and posted the initial margin. We do a P&L calculation every day. And then the other question I got that I thought was interesting was somebody asked me why the micros and minis, or S&P 500 are always quoted at the same price. And the way that the reason that happens is that we have market makers who are responsible, in fact, in a lot of cases, contractually obligated to make prices or make markets for us all day long. And if one of those 2 products, because the underlying is the S&P, got out of line with the other, there would be an arbitrage opportunity that would be taken away right away. So that's why you will generally see the micro and the mini quoted at the exact same price.
Sounds good. Sounds very good. Good questions. Keep them coming. We're going to wrap up soon. We got 10 minutes left, but there's no hard stop according to what Cynthia says. So we may go a little over 1 hour because I'm going to skip through the next example really quick. Using micro E-mini futures to hedge. And this, you can use them. I'm not going to get into this entire example because I want to get to the energy things, the energy topics. Using the micro E-mini futures, you can use them to hedge your mutual fund exposure, whether it be in your 401k or not for U.S. Citizens. You can also use it to hedge ETF exposure. I know a lot of high net worth clients or even medium net worth clients, any client that's got a significant ETF exposure and didn't want to sell out, you can use these to hedge. They're great hedge vehicles, and they're very liquid, and they're very capital efficient too. So, when you sell off your stocks or sell off your mutual funds, your ETFs, you're going to lose your dividend stream. You're going to pay a lot of costs. And if you do have these kind of portfolios, you can hedge them using the micros or the regular E-minis, depending on how large your portfolio is. This is just a quick example of a 59-year-old nearing retirement. There's always a problem when you're nearing retirement. It's called sequence of risk, sequence of bear market risk. If you have a terrible bear market going into retirement, one, you're starting to draw on your retirement money, and you also have the dual effect of, a bear market of 20-30%. So it knocks your account down appreciably at a time when, it's very uncomfortable to watch that happen. So this portfolio is at the $100,000 in the Vanguard Index 500 fund, $100,000 in the T. Rowe Price Blue Chip, and $100,000 in the DFA, that's Dimensional Fund Advisors, a very good $600 billion money manager, small cap fund. There's also fixed income and cash, total value of about $500,000. You can go through the math later on your own, a little homework assignment, but you can hedge your mutual fund or ETF exposure or portfolio using these micro products, and it's very simple to calculate your hedge ratios. All right, so we're going to skip through this, and I want to get to some of the other things. But eventually, you will have to lift the hedge. If you put these on as a hedge and the market goes down, at some point you're going to need to take the hedge off. Hopefully, the hedge gives you a very nice profit, and that profit will offset the losses of your mutual fund portfolio or the losses in your ETF or stock portfolio. So again, something for you to consider. Contact us at the CME. We'll give you more information on this, but and also Cynthia, I'm sure Interactive Brokers has some information on this too. But it's a good point. It's something that we would never emphasize, but given that we've just had a tumultuous bear market, it's something some people wish they would have done or wanted to do but didn't know how to do it. Well, now you have some little bit of tool here to get you going, in case you think the market's going to head back down after this big rally and maybe even make new lows. So. Okay, let's go over crude here. This will be the last thing, and then we'll just poll for questions, and Craig and I will answer questions along with Cynthia. But I used to get tons of phone calls. I still do. I did two examples here, getting short energy and getting long energy in the great bear market of 2014 to 2016, and then the great bull market taking us back up to before our recent bear market of the last couple of months. But I compare the E-mini crude, with ExxonMobil, with Schlumberger, with the Select Energy ETF, the XLE ETF. And again, this was back in 2014, so you're going to see notional amounts that are a little different. Crude oil was at about $115 a barrel. So the notional value of the mini crude, it's a $500 contract, was $57,500. Much lower than that. Now, obviously, crude oil is nowhere near $115 a barrel. It's closer to $30 a barrel or $28 a barrel. The upfront margin back then, or now, is $17.50. The price decline went from 115 down to 29 a barrel. So we declined 74.7%. Profit on the trade, 43,000. We'll get to the rest of that stuff in a second. Now let's compare ExxonMobil and Schlumberger and the ETF. Remember now, we wanted to normalize this to keep the notional amounts the same. So $57,000 worth of ExxonMobil is 553 shares. The upfront margin required was 28,750. Price decline, ExxonMobil, 104 down to 70. So the price decline only went down 35.6%. The profit on the trade was 18,785. Remember now, ExxonMobil paid a very nice dividend. If you're short a stock, you have to pay the dividend. So the profit on the trade is reduced by the amount of the dividend that you had to pay. And ExxonMobil's dividend was about 4%, 5%. And now it's closer to 7 or 8%. But Schlumberger, same thing, $57,500 is about 487 shares. Upfront margin required, 28,750. And you can see so on down the line. The upfront margin on the stock or an ETF will always be 50%. So you can see the price decline for high to low for Schlumberger and the ETF. Very good profit. You made a lot of money shorting energy. You just had a better participation rate, a better tracking if you shorted, if you did this trade, if you did it via the futures market, via the mini crude or the regular crude, the regular CLWTI contract. So again, but you didn't have around-the-clock trading in stocks. You don't have spread efficiencies. You can't do spread trades. You can with the ETF, but they'd be very costly. And dividends. Futures don't pay dividends, but fortunately the stocks do. But in this case, if you're short, you're paying that dividend out of your account. So it's a negative impact. You can also do the same thing. There was a bull market from February 2016 to October 2018. Crude oil went from $26 a barrel up to $76.39. So let's look at the mini crude. You can do it's the same comparison. The notional amount was $13,070 for the mini crude back when I started this example in February 2016. Upfront margin was $17.50. We already went over the price advance, and look at the price increase, 192%. Profit on the trade, $25,125. Again, you can go through everything. ExxonMobil, they only made 17%, $2,200. Schlumberger actually went down. This is particularly difficult to look at because I own Schlumberger and Exxon for a while, so I have restrictions on being able to trade futures. So it's a strange thing, but you can see the futures market is just a direct participation in the market. To get a one-to-one, it tracks the cash very well. An integrated oil company or a driller like Schlumberger or a drilling technology company like Schlumberger, they're not going to actually track crude oil dollar for dollar because ExxonMobil is a very large integrated oil company. They have refineries, they have a chemical division, they have gas stations. They're not always going to go up lock, step, and barrel, excuse the pun, with crude futures. All right. All right, well, we're nearing 11:57 here, so there's a lot of other information in the deck. Feel free to go through it. I just want to real quickly, I'm going to take 1 minute and then we'll do questions. Let's look at gold-silver ratio. Something people that haven't looked at for a long time. It might be worth taking a look from either side. I'm not sure, but the gold-silver ratio, the highest that ever traded in basically the last 10 years, was about 95. All right. So it's just the amount of silver it takes to equal 1 ounce of gold, or you just take the price of gold and divide by silver and you get it. It's been trading mostly between 60 and 90 for most of the last few years. And we have a chart there, a more short-term chart, and it's been between 79 and 93 for most of the last year. So let's say if you look at what's happened in the last couple of weeks, gold had a really nice rally. It went up to $1,700 or even a little higher than $1,700 an ounce, excuse me. And the all-time high for gold is about $1,950 an ounce. The thing is, with the economy shut down around the world, the demand for silver dried up completely. And with the flight to safety in the gold rallied dramatically relative to silver. So this gold-silver ratio, I couldn't update the chart fast enough, but the gold-silver ratio went to almost 120. So if you think eventually the economy is going to get, back to work and turn back up again, which it will, it's just a matter of when. I can't see this being a permanent thing. Silver should rally relative to gold. Again, we're not allowed to give trade recommendations here, but if you think the opposite, if you think gold's going to outperform silver, you go long gold, short silver. And if you think silver is going to start to finally catch up to gold, just like small stocks will catch up to large stocks, you would get long silver and short gold in the correct ratio. So again, there's all sorts. I like to talk about spreads because it gives you both sides of a market. Again, it makes you a little bit more attuned to the markets. You could do outright speculation in gold or silver if you want, no problem. These new micro contracts and some of the existing micro contracts, they give you a lot of great advantages that we talked about in the beginning of the talk. All right. Now, if you want, you can go through the example here of trading the gold silver ratio. I did it before the pandemic. A little bit example here, making money. One went up more than the other. And the gold silver ratio basically, went from 85 to 79, and you did well in silver. They also have percentile rankings there. Craig, you want to say something?
No, I was going to wait till you started the Q&A just on
we're there.
The hedging example that you gave. Yep.
Yeah. Couple things there. We're actually going to go to that now. I love my little two photographs here. The most important quality for an investor, it's temperament. It's not intellect. Some of the smartest people I know, they're not great traders, but it's your temperament. It's the way you react to the markets. And do you panic a lot? Are you level-headed? That's an important thing. So another great Warren Buffett quote. And then before we, show you the URLs to get more information and stuff like that in the Q&A, if you've ever had a bad day, just remember in 1976, Ronald Wayne sold his 10% stake in Apple for $2,300. At the time of this little picture, when it was taken, it was worth $70 billion. Now it would be worth about $100 billion. Anyway, so for more information, again, we're always available at the CME. There's tons of resources. Interactive Brokers is a great organization. Cynthia can point you towards a lot of resources she already has during this webinar. You can go to cmegroup.com/education or theactivetrader.cmegroup.com/microsuite, because we have a whole suite of micro products that we have just unfolded to you. So again, thanks, Cynthia, and we're going to take some time now and answer some more questions. So Craig, take it away.
Yeah, I just wanted to address a question that came in when you were talking about hedging, and just because I think it's important, because hedging can be a little bit tricky if you're new to all of this. So the question was, so if I want to hedge a portfolio, I short the mini or the micro, and the short answer to that is you have to really analyze what's in your portfolio that you're trying to hedge. And if you are long, let's say U.S. equities, the S&P, the NASDAQ, or even possibly the Dow futures could be a hedge for that. But you really want to know how correlated that portfolio is to those major indexes, because if it's not going to be an effective hedge. So these things can be effective hedge tools for an underlying portfolio, particularly in the example that Dave gave of someone that was nearing retirement that might want to do that. But I would just caution that it's something that you need to really kind of do some research on before you try to put on a hedge position for
exactly. That. Yeah, there's people that have like a technology portfolio, and they would use the Russell or the S&P 500, and that would be bad. That would not be good. You have to make sure that what you're hedging correlates very well with your hedge instrument. So if you're going to hedge a large cap portfolio or an S&P portfolio, you could probably use the S&P 500. But Craig makes a really good point. Hedging is a little bit tricky. We only put it in there not to trick you, but we may have some rough markets for a while, and some people might want to hedge. So we put this example in.
A couple questions I got on pricing of the minis versus micros from a CME perspective. We currently, the CME fee on a mini, let's say S&P 500 is $1.23. On a micro, it's 20 cents. So, and I got some questions, are you going to reduce the cost? And we do recognize that if you adjust the micro fee notionally, it's a little bit of a premium to the mini, but we look at that as a sort of premium product that affords extra flexibility and the ability to sort of customize your exposure.
So do we have any other questions?
I'm looking through these. There's a bunch out here. I'm not going to get to all of them. There's a good question, Dave. I'm gonna put you on the spot for this one, but it's very relevant given the time. I've got a question on the contango effect and how that works out when rolling contracts. And that is something to be aware of, particularly right now, for example, in the WTI curve.
Yeah, contango. All right, many, we'll give you a quick primer in this, but yes, it does have a profound effect on your roll costs. It could cause you to lose money at your roll, or you can make money in the roll. This is a big thing with commodity funds and commodity ETFs. They roll their contracts forward. So if we're in really, really steep backwardation, like we are in some markets, the nearby contract, everything's backwards. There's a huge demand now compared with less demand in the deferred contract. So the nearbys get bid way, way up relative to the deferred. So if you own the deferred and now, you want to switch into a more deferred contract, you're going to be selling a really expensive contract and buying a cheaper contract. So backwardation works if you're long in this case and you want to roll. But what if you were short energy and you had to roll into another contract? Now, it works a lot differently. Excuse me, I had it backwards. If you're long and you have these really, really, really expensive contracts, and then you want to buy something that's cheaper, it works. But if you're short, it works the opposite way because you're buying something that's dramatically higher than the deferred contract month. They're usually much more reasonably priced. But this roll risk is really, really important. And if you go from backwardation to contango, half the people are going to get hurt really bad when they roll, and half the people will get, a very favorable setup. So you have to be careful. That is a risk when you do rolling in certain commodities. It's not as big a risk in the stock indexes because typically have a backwardation or a contango like you do in commodity type markets like soybeans or crude oil or, something like that. Make sense?
Yep. Dave, do we have, I don't think I got a follow-up on that hedging question. I'm not aware of anything we have on our website that does a correlation study, and that's probably a little bit by design, right? Or a correlation analysis.
No, unfortunately, you'd have to, if you do a mutual fund or ETF, that correlation's easy because usually you can get the correlation to the underlying index. That's not hard. That's somewhere on the internet. But if you have your own portfolio, a customized portfolio, you're going to have to do a correlation. You're going to have to get the value of the portfolio at the end of every day going back a year and seeing how it correlates to either the S&P or the NASDAQ or the Russell, and then do it accordingly. You have to also sometimes consider beta adjusting. If you have a portfolio, a very large portfolio of high beta stocks, you'll need more futures contracts to hedge. And that's another consideration, but you probably just maybe consider the NASDAQ 100. But yes, hedging is definitely tricky. You definitely have to do your homework.
And Dave, I would like to jump in for just a moment here and mention there have been a lot of questions on margin, commissions, and the availability for trading. So I do want to point folks to the Interactive Brokers website. If you're looking for commission information, you'll find that and can drill down to the specifics underneath the pricing menu. Also, we've just revamped some of the website, and if you're looking for the ticker symbols and the various listings for any of the products that Dave has been discussing today, go to the trading menu and you'll find clicking there's a listing selection at the very bottom of the screen. That will take you into the different products and exchange listings where you can drill down to any of those products. Now, also on margin, in the Trader Workstation, we do have margin is available with a right click on any of these future contracts. Simply right click and choose financial information. If you are not seeing it in the right click menu, there's an arrowhead that will expand that menu, and there you can find financial information and follow that over to the description. That section will show you information, times of trading, ticker symbols to use, multipliers, and even current initial and maintenance margin requirements for your account. So I did want to point that out, all available on the Interactive Broker website. So before we do wrap up, I'm going to pass this back over to Dave and Craig to see if there's any additional questions here this afternoon.
I'm a little afraid we're not going to go ahead.
Oh, go ahead. I was just going to say, if there aren't any additional questions, I did want to remind everyone that we are recording today's session. I know Dave and Craig covered an awful lot of information here today. If you want a copy of the presentation, notice the handouts title bar that's included in your control panel. Simply double click there and you'll find a PDF of today's presentation available for download. And also want to remind you that you'll all get a direct link to today's recorded playback. As soon as I'm able to compile and upload it to our servers, we will automatically send you a link to both today's slides and access to the recording link for on-demand viewing. So with that, any additional words, Craig or Dave?
I just want to thank everybody for go ahead, Dave.
Yeah, that was just one. I wanted to thank Interactive. I wanted to thank Cynthia and to all the people that logged on for this and listened for an hour. Huge thanks. And just remember, do your homework. Contact Cynthia or Interactive Brokers if you have questions, or contact Craig or myself at CME Group. Or go to our, we have a lot of educational stuff that's available for free for those that are new to the markets. Please, please, please do your homework.
Yes, so with that, thanks so much, Dave and Craig, for terrific presentation here this afternoon. And I also want to thank all of you for your participation as well. Please stay healthy and safe, everyone. Thanks so much. Have a great rest of your day. You can exit using the X in the upper right-hand corner of the screen, and be sure you watch your inbox later on today for direct links to today's follow-up information. Thanks all. Have a great one.
Thank you, Cynthia.